Okay. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to grow your wealth. I'm your host, Brett Swarts, and each episode I am joined by some of the best real estate, financial, and wealth minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. I've actually been courting him to be on the show for about a year now since I first started out, and cold called him I think one time, listened to his podcast, was blown away, and now I have the privilege of having him on the show. What I love about our next guest is he takes action and he educates and helps bless others by taking the same amount of action in real estate syndications and purchasing, and thinking kind of differently about passive investing and or being an active participant in some of his deals as well. He is now the owner with partners of over 4,000 units, which he's going to talk to us about here in a minute. But I believe it's mainly mobile home park, multifamily, and RV space, but he'll touch on that. He is here to offer us some wisdom. Please welcome to the show, Elaine Kiyoko. Hey, Elaine, how you doing?
Hey, thanks for having me. Hello, everybody.
And he's from the great state of Hawaii, and he's going to, if you do a deal with him and you go to Hawaii, he'll take you snorkeling, he promised. So, or go see some whales. Isn't it a good time to see whales coming up here in December? Is that the time, Elaine?
Yeah, I think if you go to Maui, yeah, go Hanama Bay.
Excellent, excellent. And so to start us off, Elaine, would you give us a little bit about your background and your current focus?
Yeah, so currently syndicate deals, have over, I think 20 something, almost 30 deals we've done in the past. Um, Over 4,000 units today, but it's not really useful for people starting out. I think, I started investing in 2009 with single family homes in Seattle. And that was where I, as a young engineer who kind of walked that linear path of go to school, get a good job, I discovered what cash flow is, right? Cash flow allows you to quit your day job. So fast forward to 2015 when I had 11 rentals, and that was where I pivoted to being more of a credit investor, investing more as a high net worth individual in private placements and syndications, and here we are today.
Excellent. We're going to dive into more of those here in a few minutes, but I want to take a step back to the days when Lane was maybe in high school, maybe in college, before the epiphany of cash flow and real estate and investing. And I want you to connect with us. I believe we've all been given certain gifts in this life, and these gifts are, I believe, are God-given gifts, and they're given to us to be a blessing for others or help others. So maybe what was that one or two gifts that you identify maybe at a younger age, or a mentor did for you at a younger age? And how do those gifts help how you help people today?
Yeah, my parents were a great influence on me because they did it all the wrong way, right? They went to school, they got high degrees education. They eventually got me to do that, but just seeing their path and how much they've got, 401ks, all those retail investments, it just makes Wall Street rich, right? A good third of that goes to fees to build all these buildings, right? And don't get me started with financial planners. It wasn't until I started to invest in real estate that I realized that the wealthy do things very differently than the average person. But it's unfortunate because, a lot of us are hardworking Americans. This is all we know, right? So that's what I kind of help distill and get rid of the bad financial advice out there that a lot of us are finally opening our eyes to.
What's the biggest way to break that false belief or that barrier through traditional ways of doing things? What was it for you? And what was that big domino once you understood that, hey, there's a different way to do it, everything changed for you?
Yeah, for me, I started by doing, right? Like I started renting out a house that I thought was the way to build financial wealth, right? Buy a house to live in. Not the case, especially if we live in a primary market. But I started to rent it out, got the cash flow, and then that got me into different circles of other investors. But then I realized that, of course, like I said, the wealthy do things a little bit differently. And then my golden rule for a lot of people is don't take any financial advice from people who are not financially free themselves. It's not your financial planner who gets paid the commissions of what you buy. It's likely not your parents. It's not likely not the guy who's 20, 30 years ahead of you in the career, right? That's the reason why they're still working at JOB. Um, it's figuring out getting access to people who are kind of doing this type of stuff, buying rental properties, buying assets that eventually free them from the rat race and follow what they're doing.
Excellent. Yeah, it makes perfect sense. Yeah, make sure you're getting advice and being guided by someone who's already accomplished what you're trying to accomplish. And the best way to become Warren Buffett is to spend time with Warren Buffett, right? And to be guided by someone like that who's ahead of you. What's the most rewarding part of what you do?
I mean, the stuff that I do is pretty simple. I mean, I'm moving more towards family office consulting these days, and just like, like I'm a syndicator, so I know all the little tricks and games what syndicators do, to be able to kind of pick apart the right deals, at least find out what the sucker syndicated deals are out there. But as I've come to find, is building, going down my own path, deals are only like one third of it, of what you're investing in, right? The other part is, one third is like tax and legal, and the other part is building your legacy, right? What are you going to do when you're eventually financially free in 5 to 10 years? What are you going to do with all this wealth? And kind of the stuff that you play around with, right? Like, is a big part of that. It may not be particularly deals, but it's like paying less taxes and stuff like that.
Yeah, we like to say it's providing a transformational exit plan, right? And that could be different for different people. We just closed a deal in Alabama for 2.6 million, and he was in his early 40s, and he's looking to transition out of the business world into the commercial real estate, multifamily space of development and ownership world. And so for him, it was transformational to be able to sell out of his business, defer hundreds of thousands of dollars of tax, and use those same funds that you would have paid in tax to build apartment buildings, in Tennessee. And so, but for some of our clients, it's baby boomers, right? And they're older and they're looking to actually retire from the toilets, trash, and liability. And they've made their wealth for 20, 30, 40 years, and they're tired of all the laws and keeping up, and they just want preservation, and they actually want to sell and be passive, whether that be in securities, but a lot of them want to be back into real estate investments, just not having to do the day-to-day themselves. Go with folks who are proven, have a track record, who are in the game, right? Who have the energy and the time to do that, and then they can spend their time with their grandkids or traveling or whatever that might be for them. So, yeah, I think that's a big part of it, right? Because I think it's so true. It's one thing to make the wealth, to have the cash flow, but it's another thing to also feel trapped by that sometimes, right? Where you have too much wealth or too many deals. I met with a gentleman last week. They literally have 1,100 units. His dad helped build like a real estate empire here in California, and he left it to 3 kids, and now they're just all consumed. They have no debt, and they have just all the rents, all the collections. They've tried to automate so many things, but all the changes of laws, and they're just saying, you know what, I'm in my 50s now, going on 60, and I just kind of want to be done with this, but I don't want to just sell and just pay all this tax and just not be good stewards of the wealth that we've been given. So oftentimes they feel stuck between a rock and a hard place. Which leads to my next question, Lane. What's the biggest frustration you've sensed or seen with a friend, client, partner, or somebody when it comes to capital gains tax deferral?
Yeah, I mean, when people do like, I do initial consults, I think one of the biggest epiphanies I always see with these guys is like they have so much in assets, but it's barely making anything, right? Like, I mean, if you model like when you pick up a rental property, you're making almost 30% a year. Not with cash flow. Cash flow is part of it. Mortgage pay down, the tenant paying on your mortgage, appreciation, and the tax benefit. It can be damn near 30%, even on a turnkey rental. Um, and then you do that over the years that your property appreciates and your tenant pays down your mortgage, you get a build of equity. Your return on equity goes down to almost under 5%, and at that point you should have sold, refinanced, or gone into the next deal with some kind of 1031, we say bonus appreciation or your type of strategy, the DST. But it's just people don't prune their investments. There's this idea out there, you buy and never sell. I mean, yeah, it works, right? But I don't think it's the greatest strategy out there, right? You buy, you get your equity up, and then you sell that equity off, and you buy 2 more, right? And you keep re-leveraging into good deals that, especially cash flow, right? Like, we don't want to be all irresponsible about this. We want to keeping our cash flow high.
Yeah, so well said, right? It's a time to sell, it's a time to hold, there's a time to prune, there's a time to harvest, right? Obviously, be wise about it. If you can find a 1031, great, go for it. And if you want to do some cost segregation to offset, that's also a great strategy. or use a deferred sales trust, right, to get a little bit of both. What I like about the deferred sales trust, it gives you a brand new depreciation schedule, which is really interesting. Back to this last family I'm helping out here, they have a very low basis, and they have, and exactly what you're talking about. They have so many units, Lane, and so many properties spread out all over kind of Central California that they're just like, I know we haven't raised rents that we should have. We haven't kept up with everything. We have no debt, and it's almost like they're paralyzed because they just have so much. They don't need anymore, right? But they also don't want to overpay for a 1031. And so yeah, knowing when to sell, knowing when to buy. By the way, for you, how have you kind of seen this marketplace, Lane, when it comes to low interest rates, opportunities? Kind of give us your pulse now. We're now at the end of September as we're recording this, so just before the election, but a lot of it has kind of been seen of what's happening. But what's your take on what's going on right now?
Yeah, I'm not too concerned about the election or too much the pandemic. I mean, thankfully, I think April and May, I was a little worried, right, with collections. Normally, we average 97% collections. You're always going to have a few deadbeats out of 100 not pay. But I think at the very worst, some of the worst properties like drop down into the 90% range or low 90s. On these stabilized properties, you're still cash flowing at higher than 60% collections anyway. So you got a big buffer there. I'm not concerned one bit of like the media is always selling kind of some kind of story, right? Or podcasters are always saying something to get you to watch the next podcast. And now it's like, oh, the stimulus is going to dry up. I'll put it this way, I was more concerned with April and May rent collections than that storyline. And I'm just depends what you're investing in, right? Like me personally, I only invest in deals that are stabilized, that cash flow day one, that are properties with sellers with problems, not problem properties, if that makes sense. So yeah, I think there's a narrative saying that there's gonna be a lot of like, after all this like deference wears off, there's going to be a lot of distress inventory. Like, yeah, probably, but I just don't buy them. So I just go after cash flow, not using non-recourse debt, which you need a 90% occupied property on. So that's just where I'm at. I mean, I think if you're one of those operators that goes after really heavy, hairy deals, I think, yeah, things can get good. But, especially for like, what frustrates me is like you have an unsophisticated investor that just sits at home all day and listens to podcasts, watching videos, never really getting their boots in the ground. You're not gonna really, yeah, you hear about inventory that's distress coming online, but you don't have the expertise level to go after that stuff. I stay away from that stuff. So that's just kind of where I'm coming from, what I see.
Yeah, it makes a whole lot of sense, right? Yeah. So what you're saying is, well, first of all, I really like the line you said: find sellers with problems, not properties with problems, right? So, and sometimes there's always going to be maybe a little bit of both, but the motivation and the key to the seller selling could be a partnership, it could be health, it could be whatever, right? And you're coming in, and hopefully it's as turnkey as it can be, maybe a level of value add, right? But it's not the foundation of it is still a solid deal. That being said, do you buy? Where do you like to buy? Where are you finding deals? And even before you go there, though, and I also agree with you too. I feel like there's going to be some distressed sellers that have some problems with their debt because they're either overextended. It's not necessarily going to be their problems, but the banks are going to try to find a deal. So I feel like the deals this time aren't going to be so much that the banks are foreclosing. It's more like going in and maybe helping out a seller who needs to reallocate, who doesn't have enough reserves, who spread themselves too thin with multiple properties, and now perhaps you could renegotiate a percentage of that deal. That's just kind of my thought of what I've kind of gathered, being a multifamily broker here in Sacramento, but every market's a little different. Do you sense any of that as well, Lane, or what's your take on that?
I mean, I'm just kind of getting myself into like a distressed seller's mindset, right? Like yeah, there might be some issues at my property, but I'm not doing anything. I'm gonna be stubborn and try and fight, right? Until I'm not gonna sell and give up until I absolutely need to. And that what the motivation is gonna have to be is my occupancy and especially my collections start dropping like a knife, right? The way that's going to play out is like, just to use this as an example, like right now, what if like a seller is going through some cash flow problems, they stop fixing stuff because they don't have the money to fix it. Tenants get pissed off, especially with all like the the not being able to evict tenants now. It makes things difficult. But if you turn into this situation where you need occupancy and so you're not in a heavy hand and going for collections, you start to train your 97% collections, your B class tenant, it starts to drop those collections. You start to create class C tenants who don't pay and are living life like they don't care, right? And that's a community that I wouldn't want to buy because that's a problem property. Um, that's kind of what I think as I start to think through it. If I was a seller, I'm taking advantage of Fannie Mae, Freddie Mac deference. My collections are dropping. At that point, yeah, I want to get rid of this thing and hope I can find some sucker who is willing to take on this project. And they definitely need to be capitalized to get through the rough patch, to retrain tenants to be good paying citizens. And that's going to take at least 3 to 6 months.
Mm-hmm. Yeah, so well said. I like the psychology part of that a lot. So now let's dive into maybe it's a couple deals. I know maybe you can't share too many particulars because of some rules, but what can you share in regards to if someone says, yeah, you know what, Lane, I want to get into investing. I have some cash. I'm an accredited investor, and what opportunities might be available, or what are some of the things that you're looking forward to buy here?
Yeah, I mean, I've kind of changed my strategy lately. We used to go after a lot of Class C type of deals because I got wooed by the cash flow. Just like guys who look at like $50,000 pieces of junk, right? That rent for 850, like the rent to value ratio, just looking on that basic level just stands out, right? 1.5 rent to value ratio. It's no different in Class C assets, right? Like they appear to cash flow, but never happens, right? It's just such an unreliable tenant basis, and especially going through a pandemic, they're just a vulnerable population. So I'm trying to stick to more Class B properties, 1960s, 1970s or newer, but in a better area, B or A minus area. That's what I'm kind of sticking towards. And then I would call them like more yield plays where there's not too much of a rehab component. So light value add, so $4,000 to $6,000 per unit, enough to put in new flooring, new appliances, but not any heavy stuff. Just to bump the rents up 100, $150 or something like that. And then, buying in a good area and like look at the interest rates, like looking at like 2.6, 2.8. I mean, shoot, like you can buy a random property out there and do pretty well with that kind of interest rate. And I think now's the time to be buying good blue chip stocks, especially with inflation coming.
Yeah, really well said. And it's interesting. California
I'll,
and
I'll
every
correct
market.
myself. I said blue chip stocks. I'm not a
Yeah.
big stock fan, but like, type of good apartments,
Hmm.
good like cash flow investments, I consider like blue chips, right?
Right. Right. Yeah. 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 The solid Bs and solid B locations or A minus locations. Those are kind of like the go to, right? You're not buying the high end institutional Class A, really high construction costs, very low cap rate, and you're also not buying maybe the lower ones where the tenants are more vulnerable to this uncertainty with jobs and where the economy could be going for income for them. And so just a solid blue chip type of properties in that B location. Is that a fair summary?
Yeah, yeah. And if I'm looking for a little bit more like risk reward, I'll probably just build a new damn thing, right? But make it cater not to the luxury class, but more affordable new builds.
Mhm. Beautiful. Now, where are you finding deals? I'm in California, and I honestly the only deal that I've invested in is a senior housing assistant care, memory care, and independent living facility. It's more of a business than it's just real estate, and it's based upon the demographics and the income levels and such. And there's such a big need for that. So that's literally the only thing I've touched in California for over 5 years. Before that, it was kind of distressed real estate. So you're in Hawaii too, so I don't know what you're seeing or where you're buying, but I know you mostly buy, I think in the Midwest to the East Coast. But correct me where I'm wrong. Where are you buying?
Yeah, sure is in Hawaii or California, that's for certain. But yeah, I mean, the high level, you go to more red states, right? Because better landlord laws, and then you kind of pick the places that are good population or job growth markets. And then at that point, it's just where can you develop those broker relationships best then. Personally, I'm looking at a lot like Huntsville, DFW, all of Texas, starting looking like Phoenix. I think Phoenix is a little more speculative. You barely cash flow there, but Phoenix can actually blow up in terms of 4 to 7% rent increases year after year. Um, so kind of getting a nice little blend of those type of markets is kind of where I'm looking.
That's great. And what about product type? Are you looking just mainly multifamily? Are you doing mobile home park? Are you doing senior assisted living or any RV? Walk us through kind of the product types.
I know like mobile home park, or I know like a residential apartments like the back of my hand. Mobile home parks is similar. There's some nuances there. But I mean, this is kind of a newer thing. I'm kind of looking at some office space right now, and I know everyone's like WTF, right? Like, and I get it. Like, yeah, it's been beat up. It's the I don't know. It's just been run through the washer, buried through the dirt. But like the fact that like if normally occupancy on an office is 80% and you buy it at like a 7 cap at 60%, and now you can turn around and break even is like in the 40%, and now you can turn around and you can say, hey everybody, we're gonna undercut the whole freaking city now. I don't see how. I mean, I that's all part of investing, right? It's not really what the asset class is, but like how low based on your cost basis can you buy the thing, and how much can you cash flow, and then how much can you take advantage of the situation. I mean, the great thing is you got to be crazy to build an office space today. That's awesome for me, right? If I got the best. uh,
Yeah, I love that, Lane. And to that point, working with a syndicator operator in San Antonio, and he actually bought an office pre-COVID, but for the opportunity in an opportunity zone to convert it into apartments. And so that still works, but still, yeah. So if you could maybe repurpose it, right, or to change the asset type, that is something that I think you can find some deals on. So, by the way, Lane, there's one thing that really sticks out for me, and as you talk and the way you think, and I really love it. I want to point it out for the listeners, and it's actually by a book that I'm recently reading. Ray Dalio talks about the principles of success, and he talks about trading the joy of being right for trading for the joy of what's true. Okay, so like as we're looking at deals, and what I glean from you is you're you're kind of agnostic in the sense of, I mean, you have your values and you have your thoughts for where to invest, but it's like, you know, I don't, as far as being right, that could be here. I just want to find out where the deal's at. I just want to find out what's true. I want to find out where's the cash flow, right? And you have a great way of just separating those things. Am I on the right track there?
Yeah, I mean, there's kind of two layers to this, right? Like people always ask, well, where do you invest? I'm like, oh, this question again, right? But if every freaking person is looking in Dallas, Fort Worth, I mean, they're all bidding each other up. I mean, you see everybody, same people at the best and final table. I would rather go out to like Des Moines, Iowa, or Huntsville, Alabama, or wherever, where there's heck of a lot less people, bidding things up, and then adjust my underwriting accordingly. Whereas I might assume that the rent might go up 2%, 2.5% in Dallas. Cool, I'm just gonna go to like Jackson, Mississippi, and just assume the rents are gonna go up 1%, right? And that's like it's just another layer. Like, I mean, another idea like that I have is like a lot of California investors go and invest in Las Vegas, and that's why that Vegas sucks to invest in. You can't cash flow there because you have all these unsophisticated investors, all the dumb money going there. And so it's like, take something as crazy as like, I mean, I'm not a fan of retail storefront, right? Like I think, I mean, I might be a little bullish on office space, but retail storefront, I still not see sold on that. But like, it's where the opportunity is, where the less competition is. Where is the dumb money going? And get away from that all the time, right? Everybody says, oh, I don't think. I see in my office people are working from home. Yeah, we don't need to go work. We don't need to come to office. Yeah, that's nonsense, man. Like you gotta work face to face, man. And call me conservative, but like class A trophy assets in the metro area, they ain't gonna go away, right? they may not build anything more, which is great, right? But it's not going to go away. But dig into the numbers, right? Because most semi-sophisticated investors kind of talk in this speak, or you know, but you got to dig into like the sub-market and what's happening in that asset class and what are you buying it as a basis. Anything makes sense at a certain price.
Absolutely, because then it's replacement cost, right, and cost of construction, and then the ability to reposition if you need to. But you're right. I think it's obviously it's a flight of fear, and the world has completely changed forever. Well, maybe, maybe not, right? I mean, in some ways, sure. In some other ways, yes. Eventually, office will come back. The question is staying power, and the question is can you buy it for a low enough basis and cash flow and have a big enough reserve to weather that storm? By the way, I own as part of a syndication group medical office. Medical office has been really good to us. Now we bought it at a very low basis and got Kaiser to do a long-term lease before COVID, right? And they signed up, and that was big. That was huge because it was Kaiser, but it was medical office, and they're a big group for hospitals, one of the biggest in the world, really. And so every deal's a little different, and so I like that approach. Excellent. Let's see. So are you ready for the lightning round?
Yeah. Yep.
All right. Here we go. Knowing what you know now, Lane, if you go back to your 25-year-old self, what's the one golden nugget you would tell yourself to do?
When I was 25, I think I had like 5 or 10 rentals. I probably would have told myself to do private placements and syndications a little bit earlier, and stop paying down my mortgages on my rentals too.
Excellent. Yeah. I like that. What is the number one book you've recommended or gifted the most in the past year?
Real Estate Millionaire Investor by Gary Keller has a lot of fundamentals. But after that, I'm like, yeah, stop reading books, guys. Go out and analyze deals.
Love it. Take action, right? Give me a mobile or digital resource you recommend for your business.
I like the ITR report is a good one. There's so many like things out there that they're just trying to sell newsletters or they're just trying to skew towards one asset class. A lot of things are just, and don't get me started on like mainstream media, right? That the headline says one thing, but when you actually read the damn thing, it says something a little bit different. Um, a lot of people who are just selling like gold just so you get affiliate fees and gold, for example. Check your source, right? I mean, there's very few resources out there that are just, they get paid to do good information digging. And yeah, ITR is a good one like that.
Excellent. Favorite leadership quote or theme that you strive to live by?
Ooh. Things happen for a reason, I guess. Some people lost their job and they called me and then they're like, yeah, I lost my job, or I realized that pandemic can put me back. And I'm like, yeah, you need multiple streams of income, man.
Absolutely. It forces you to adapt and shift and to diversify your income streams, right? Not being tied to just one source of income. Well said. What are you curious about right now?
I am curious on what sectors are going to be um, the place to invest now that sort of demand is shifting. Like, I mean, I'm a fan of multifamily for sure, right? But I think the institutional players are going to start to see the resiliency of multifamily and may not be the thing to invest in the future, right? It may be buy old movie theaters, right? I mean, just kind of just the supply and demand kind of goes back and forth. But overall, I'm just looking to pick up more and more cash flow. That's it.
Beautiful. Last question, and then remind our listeners where they can find you. So, after all your success, Lane, taking your journey from W-2 to passive investor, financial freedom, and to help others to do the same, over 4,000 units, and your podcast and everything else. How do you stay centered in your values, Lane? And then how do you stay encouraged to reach for new goals?
Um, I love trying. I've been trying to focusing on like spending less, bringing my mortgage or my rent mortgage payment down. Trying to get that under like 4 grand, which is possible here in Hawaii. You can live pretty frugally. So that's always kind of a little hobby of mine. Um, But yeah, it's all in pursuit to how much can you grow, right? It's not how much you make, it's also how much you save and you net, right? So the more you net, the more you can invest, the more you can grow your net worth. And maybe you call me weird, but it's kind of like it's just a game, right? It's just a number, right? It's like playing ping pong and trying to get the best score.
Love it. Sounds great. And for our listeners who want to get in touch with you, Lane, what's the best way for them to connect with you?
They can check out my podcast, Simple Passive Cash Flow. I originally talked about a lot of turnkey rentals in the beginning, and but moved more towards accredited investing in syndications and private placements. And my email address is lane@simplepassivecashflow.com.
Beautiful. Well, Lane, I want to thank you for being on the show, sharing your wisdom, sharing a part of your story, and inspiring us to take some action on our real estate investing. So get out there and analyze some more deals, everybody, and just stop reading all the books and just listen to these random podcasts like you're listening to right now. Go and find some deals and or just connect with Lane and deals that he's lining up and invest alongside with him. And with that being said, thank you, Lane, for being on the show. And I want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust and investing with someone like Lane is the best way for you to grow your wealth. With that, please go to capitalgainstaxsolutions.com if you have any property or asset that you're selling and you like a free consultation, and you download our free ebook, it's 9 steps to basically selling your real estate or business smarter, all capital gains tax deferred. With that, everybody, thanks so much for listening. Go bless some people, and we'll talk again.